All right. Hi everyone. In this video, we'll cover a subtopic of behavioral finance, that is individual biases. This topic is based off a part of the CFA Level 3 curriculum. So if you're preparing for that exam, I think you'll find it to be interesting. Okay. So the reason for covering this topic is I find it to be interesting in the sense that a lot of the other topics that we go through in finance, they mostly cover analysis part, like the mathematical part, that can be equity modeling, or it can be part of market research, projecting cash flows, calculating discount rates, whatnot. But this is very different in the aspect that it covers the psychological aspect of the investors. So before we go into the behavioral biases of an individual, we first need to understand what is a bias. So if you do a quick Google search, you'll find the definition of bias as a strong feeling of favor towards or against one group of people, or maybe one side of an argument, often not based on fair judgment or facts. Simply put, it is basically having a predetermined outlook towards a person or an argument, and in our case, towards like assets that we'll be dealing with. So why do we study behavioral biases in finance? So I'm sure you might be aware of a model called CAPM, that is the capital asset pricing model. So like CAPM and a lot of the other models that we use in finance, there are many assumptions attached to each of them. A main assumption in most of the models is that the investors are rational. They only look at the risks and the returns associated with different assets or different stocks or different debt, and they base their decision making entirely on those risks and returns, and that's it. But in reality, people, we are not machines. Like humans, we have emotions, we have limitations in processing information. So there are biases when humans are dealing with finance. So that is why we study the behavioral biases we encounter in finance. So let's go through them one by one. So we categorize biases into two parts. One is the cognitive bias, and the other is the emotional bias. So cognitive biases, they arise because the investor is not able to accurately process the available information, or it may be that he doesn't have access to the entire information, or he cannot capture everything in one go. So this alters the decision making process from the ideal behavior. Similarly, in emotional biases, a person is overwhelmed by his feelings and emotions. So sometimes that will, deviate a person's investing behavior from ideal. So we'll first look into cognitive biases. So cognitive biases are of two types: uh, the belief reservation bias and information processing bias. We'll first look into belief preservation. So as you notice, belief and preservation. So belief is something that an investor already has decided. So let's say somebody did an analysis, so that becomes his belief. And preservation is basically looking only for information, or making sure that whatever his analysis holds true. So these biases are part of the cognitive bias, and the second is information processing. So basically, these arise from the fact that investors, they don't process all the information, or even if they do, they don't process it rationally. There are irregularities attached to it. So to begin with, we'll first look into the belief preservation biases. So there are multiple types of belief preservation biases. We'll go through each of them with an example. So the first one is conservatism bias. So in this type of bias, what an investor does, he basically just ignores the new information that is coming in and bases the model of the previous information that he had. So let's say this guy started an analysis in 2023, and he looked at last 10 years of data for a stock. He bases a 5-year projection. He looked at probably the market data as well, how the economy is doing, and he did a 5-year projection of that. And let's say 6 months later, some new information comes in. Like information comes in every now and then, but let's say 6 months later, some information comes in which might be important to this analysis. But because this person has a conservatism bias, he'll just ignore that. What that means, he is putting undue weight to the information that he had at the starting of the analysis, and he's putting very low weight to the new information. The opposite of this is recency bias. So recency bias is basically somebody, who puts undue weight to new information that is coming in. So let's say some information comes in that stock will go up, or stock is performing really well, then he'll immediately, you know adapt, change his projections. It might be that, that is a one-off decision, but that is something that a person holding recency bias has. Another bias, that is confirmation bias. So I find this bias to be one of the most important ones, in the sense that I myself have felt that I have, shown this bias a lot, and not just when it comes to finance. It comes when it is in relation to general activities in my life as well. So a person who is displaying this bias, he only looks for information that supports his thesis. So let's say if that person has invested in stock A, and he did some analysis that this stock will go 50% in 2 years, he'll only look for information that supports his thesis, in the sense he'll read articles that A is performing well, the sector where A is growing very fast. He will just ignore the information that is anything negative for the outlook of the stock. So example of this in my understanding was in 2022. I had a thesis where I was thinking that, okay, the markets will probably end up in a bear market, the economy will slow down. So I exited a lot of my positions in early January, and it was going well till, I think May or June, when the market was going down. But even after, it started going back up, I was still looking for information stating that, this is just a bear market rally, and then market will eventually go down even further. So because I was sticking to that particular belief, I missed out on a major rally that happened that year, and the one that's happening right now. So this is something very important. A person should mentally take a note of the fact that this is inherent to a lot of people, and we should look at both sides of, the analysis. So if I'm on a bear case, not only I should look at information regarding a bear case, I should also look at, what the bull case is. And I'm sure there are people who are bullish at the time I am bearish. So let's see what their analysis says, and maybe there are points in their analysis that actually make sense. Another bias is representative bias. What happens in this case is, a person, let's say he started investing in a bull market run that ran for 3 years, and that is when he started, and that is his entire market experience. So going forward, he might base his future projections on the fact that, markets only go up, because that's the only experience he has had. Even if the markets are volatile, or let's say the market is bear, his thesis might hold that, it's a short term problem, markets will go up. So that is one representative bias. Illusion of control. People who show this bias, they tend to believe that they have control over the functioning of the markets, and their actions, they can influence, the outcomes. An example can be somebody who's in a senior position in a company. Let's say that company A is doing well, the financials are good, the product is selling well, and because he has information about the day-to-day activities of that company A, he might tend to believe that, this will outperform the market, so he goes overweight on the position. But the fact is, nobody knows what's going to happen tomorrow, and he might have one belief, the market might have another belief. So for example, this company might be growing at 20%, which is actually a good number, but the peers are going up at 25% in their growth. So the market will, say that this is actually not a good number compared to what the industry is doing. So this is something that people should keep in mind, that all the outcomes in the market are not 100%. There is a probability attached to everything, and they should keep a open mind to that. Another bias that is very common is hindsight bias, is where people believe that the past events that happened, they were very reasonably predictable, and then they believe that using this information they can also predict events going forward, which will distort their analysis. So for example, in 2020, I remember, I think March 2020, when the markets suddenly tanked and then they went up. I think the bottom was around 7700, and I think it just happened in like 3 days. A lot of people will look at this information and say, okay, this was definitely predictable, in the sense that the countries, they went into lockdown, so of course the market would go down. But nobody would have known how much it would go down and why suddenly it went up, because the government support came in. We have this information at the moment. That is why we are saying that okay, this was predictable. But in reality, nobody knew when this downfall would have stopped and how much it would have rebounded. Then we'll also look into other types of cognitive bias, that is the information processing biases. So one example is the anchoring bias. So what happens in when a person displays anchoring bias, they tend to anchor their outlook and projections based on some particular value. Let's say some stock A is currently trading at $70. I look at the numbers and I'll assume, okay, this stock will give me a 10% return over 6 months, 77, based on the financials and the projections. But one has to understand why we are basing our analysis of 70. Is 70 the right anchor here? What is the basis for the price being 70? It might be that the stock is already overpriced or underpriced. So these are things that a person needs to keep account in order to mitigate the effects of anchoring bias. Another example is mental accounting. Mental accounting bias can be displayed by people who tend to believe that they are diversifying, but in reality they might not be. So let's say we go through an example. I'm an investor X who invests in stock A, B, C, D. Let's say I invest 50 here, 30 here, 10 here, and 10 here. Right. Or maybe these are not stocks, these are 4 different asset classes. And because these are 4 different asset classes, from an investor point of view, I am diversified. Correct. But let's say there is another asset class E, where if I invest 100, I'll get the same the same return profile as these 4 diversified, and maybe a better risk, like in the sense that this E will have a lower risk compared to what this diversified ABCD has. But because the person is displaying mental accounting bias, he believes that because the money is segregated among 4 different assets, this is a better scenario than putting all the money in asset E. So this is something that people need to be careful of. Another example which we see sometimes is, let's say there is a gambler who starts with money 100. He wins a bet, he makes 100, and then he keeps the 100. That was the original principle, and this is the profit. So people who show mental accounting, what they'll also do, they'll assume that this 100 is their principal, they'll keep it in their pocket, and now they will start gambling with this 100. If they make more money, that's great. If they lose money, they ended up with 0. But people should be mindful of the fact that now, because this 100 is also your capital, so you should treat this 100 and this 100 equally, because if you treat them separately, then you are mentally accounting them as separate entities, but instead they are just one entity in total. Another bias that we deal with is framing bias. Let's say I'll give you a simple example. So people react to information depending on how it is presented to them. So if a stock advisor tells his client that there is a portfolio A, there is a portfolio B, and based on the client's requirement, there's a 80% chance of this to succeed, and a very simple example, this is a 20% chance of failure. So person will simply go with A because it's framed in that way. He'll not go with B because the framing was not appropriate for him. but in reality both of them have the same, return success probability. Another bias that we deal with is availability bias. So this is from the fact that an investor in reality cannot collect all the available information, because all the information is actually not accessible, and it's not even feasible for somebody to process everything in one go. So what a lot of people do is we'll just go with a rough estimate. That rough estimate or is called like a shortcut or a heuristic approach to estimate what the probability is of their outcome. Okay, next we'll cover some emotional biases. These arise because people they get overwhelmed by their emotions and not by their actual rational you know model analysis. One of them, loss aversion bias, is where people tend to put more emphasis on avoiding losses than they do to achieving gains in their portfolio. We can go through this by a couple of examples. A person, let's say, invests 100 rupees in a certain scenario, and they make 110. This 10% gain might not be as valuable to that person of, let's say, if he invests in another stock at 100 but that goes down to 90. So even like the loss here is 10%, but this 10% loss is very painful compared to what the gain is here. A person displaying loss aversion bias, he would tend to hold on to this position. He would want that, let's say, he would just want, okay, this goes to 100 again, I'll sell it, I'll not take a profit, but they just don't want to take a loss. So people who display this type of bias, what they do is they just tend to hold on to these loss making positions for a very extended period of time. Some people, what they'll do, they'll buy at 100, this goes down to 90, they'll buy it even more to reduce their average cost. It goes down further, they'll buy more to reduce their cost even further, in the hope that once it goes to that break even value, they'll get out of the position entirely. So this is a loss aversion bias. Overconfidence bias is simply putting undue weight to your ability to predict the outcomes correctly. One has to understand the fact that all the outcomes are a probability, and there is no guaranteed outcomes in the market. One of the other examples of emotional bias is self-control bias. So a person displaying this bias does not act in their benefit in the long run. They fall to short-term gains or losses. What do we mean by that? So let's say an analyst, he's analyzing a stock that is currently at 100, and he believes that this will give me a 50% return over a 2-year hold. This go up to 150. In the next 6 months it goes to 130, and the person gets overwhelmed by his emotions and he exits the position, that let's just book this 30% profit and be happy with it. But had he acted in the long run, he would have probably made more money. Another example can be the same analysis, that this goes from 100 to 150 but it goes to 95 in the next 2 months, and the person starts to panic that, oh, maybe my analysis is wrong, maybe I missed out on something. He goes through the analysis again, still couldn't figure out, and he panics and he sells. So when he does that, he is acting in the short term. He is not able to overcome the short term loss, and it may be possible that there is a general market correction, or there is a short term blip in the economy in general, and this will eventually reach the target, but because he exits the position, he is not acting in the long term, and he falls to this self-control bias. Now for the last 3 biases, we'll go through the status quo bias. It's very simple. This is basically with people who they are uncomfortable making changes, and this is very common with people as they grow older. People get stuck with their habits. They are not comfortable making a change. Very common can be seen with people, they they have a lot of money, they'll do an FD because this is safe, there is no risk involved, the returns are okay, gets the job done. They'll be hesitant to, invest that money in stocks or any kind of other asset because there is risk involved to it. And the other thing is they are not comfortable making change. They have been doing this since they started investing, and that is what they prefer doing. So this is an example of status quo bias. Another example of emotional bias is endowment bias. This is where investors tend to treat a certain asset differently because it has been inherited or it has been endowed to them. For example, there is a child, he gets some stock X from his parents. This stock X goes down 10% over the 1 year he got the stock, and the market analysts say the outlook is still bearish, it will go down even further. The right thing for this investor, like this child, would be to exit the position and get into a position where he would actually make money. But because he has emotions attached to this particular stock X, he continues to hold on to this position because this was given to him by his parents. So this is an example of endowment bias. A person displaying this bias should question himself, like, would he actually buy this stock had it not been given by their parents? And if the answer is no, then he should understand that there is no point holding this. Regret aversion bias. So regret aversion bias is basically investors, when they are given a bunch of opportunities to invest, they sometimes prefer to just invest in all the opportunities so that they don't miss out on some particular asset performing well. So for example, let's say there are 4 assets. The client is provided with these 4 assets, and the advisor says the probability of success is high here, success is high here, low here, and low here. But if this succeeds, the wealth will grow 5x. This succeeds, the wealth will grow 3x. But if these two succeed, the wealth will only grow 1.5x. So a person who is showing this regret aversion bias, he'll say, okay, I'll just invest 25% in all 4 of these assets, so that if these two end up performing well, he would not regret missing out on these returns. He would actually be a part of the success story. Another example of this can be seen in FOMO, which is commonly known as fear of missing out. So what happens in this case is, let's say I have a friend who was investing in some asset or cryptocurrency or something, and that went up 50% in no time. And then few of my friends also started investing, and they also made more gains. So person displaying this regret aversion bias would probably want to take part in this scenario, get in the action, get some gains, because, and this is without doing analysis, just because he doesn't want to regret missing out on the rally. So it is important for somebody who is displaying this bias to carefully evaluate what he is investing in, because as it said, like, the success probability is low but the gains are high. But one should understand why the success probability is low, not just look at what the gains are. All right, hope you liked the presentation. All your comments are welcome, and please do criticize if there are changes that are required, and I'll definitely work on that. Thank you.